Good morning. Welcome back to lesson 3 as part of our exam preparation for FAC2602. So in today's lesson, we will be working through question 2 the May-June 2022 examination, so being the first semester's examination paper. We are given 66 minutes for this question. However, the video will not be just 1 hour long or just over 1 hour long. If I have to guess, we will probably spend about 2 hours on this question. Now, if you go to the required section, you will see that we are required to draft the consolidated statement of profit or loss and other comprehensive income counting 35 marks. And then we have the revaluation surplus, retained earnings, and non-controlling interest columns in the consolidated statement of changes in equity. So only those columns in the consolidated statement of changes in equity. However, I have decided that for the purpose of ensuring thorough exam preparation, I will be doing the entire set of consolidated financial statements. So we are going to do the consolidated statement of profit or loss and other comprehensive income. We will do the consolidated statement of changes in equity. And finally, we will do the consolidated statement of financial position. So I have decided to split this question into different parts. So I will see how far I get for part 1. So this is obviously part 1. We will see how far we get. And then in the next few lessons, we will be finishing question 2 of this exam paper. And I have taken the decision to prepare the entire set because that will give you a good foundation in order to make sure that you actually understand the principles that you will be using in the upcoming examination on the 24th of October. So without any further ado, let's get to the actual question. So if you read your required section, we are preparing the required financial statement as well as the columns, but for the purposes of thorough exam preparation, we will be doing the entire set. So we will change the required part to, prepare the consolidated financial statements of the Runette Limited Group, and obviously that will take us longer than the given 66 minutes, which is why I said we're going to spend quite a while on this one. Alright, so we have Runette Limited Group. So we know that our parent is Runette Limited and the other company will be the subsidiary. And it is for the year ended 31 March 2020. So as always, we indicate our current financial year. Let me just go back here. So our current financial year, so the year that we are busy with, runs from the 1st of April 2019 and ends, or starts on the 1st of April 2019 and ends on the 31st of March 2020. Okay, so let's start with the information given. So Runette Limited and Netix Limited are companies in the telecommunication industry. The financial year end of both entities is on the 31st of March each year, and below is an extract from the trial balances of each entity on the 31st of March 2020. Okay, before we start with additional information, let us see if we can work out the percentage interest of the parent in the subsidiary that we will use in our analysis of owner's equity, both for ordinary share capital as well as preference share capital. Now, just before we start, I would just like to indicate that this question is based on the same principles or the same procedures that we have followed in question 11 for tutorial letter 102, that being where the group was formed in the current financial year. This will also be the case in this question, so just take note of that. So we will need to calculate the pre-acquisition profit as well as the post-acquisition profit for the subsidiary, and then allocate the amounts appropriately. Alright, but let's work out the percentage interest. So if we go to debits, we will see the investment in Natex Limited at fair value. So we want to work out the percentage interest of the parent in ordinary share capital. So the parent possesses or owns 201,000 ordinary shares in Natex Limited. So to work out the percentage interest of the parent, you will take the 201,000 and divide it by the number of ordinary shares issued by Natex Limited, which is 268. And then multiply with 100 because we want the percentage. So that should give you an answer of 75%. So Runate Limited, let me just move here, sorry, for my keyboard. So Runate Limited has a 75% interest in the subsidiary's ordinary share capital, meaning that your non-controlling interest will be 25%. And then for your preference share capital, the percentage interest of the parent will be the number of ordinary share or preference shares owned, So the number of preference shares owned by the parent is 80,000, and the subsidiary has 100,000 shares issued for its preference share capital. Okay, so 100,000 preference shares have been issued by the subsidiary, so that will give us an 80% interest. Okay, 80,000 divided by 100,000 times 100 will give you 80% for Runate Limited. And the type of preference shares, is cumulative, as is usually the case in this module. So if a preference dividend has not been declared in a certain period, it will just accumulate and be moved over to the next period, meaning that we have to pay that period's preference dividend in the next period. Okay, refer back to Learning Unit 9 that addresses the treatment of preference dividends during consolidation. Alright, and as we know, we will use the 12% to calculate the value of the preference dividends. Alright, so just keep that in mind. So we have calculated the percentage interest of the parent in both the ordinary share capital and the preference share capital. So now we can move on to additional information, point 1. It says that Runate Limited acquired its shareholding in Natex Limited on the 31st of August 2019. Now, if you look at your current financial year, you will notice that the 31st of August 2019 falls in the current financial year, meaning that the group was formed within the current financial year. That is why I said we have the same situation as with question 11 in tutorial letter 102 that was covered in the first lesson. So we will again be required to calculate a pre-acquisition profit as well as a post-acquisition profit for the subsidiary. Okay, and we need to allocate the items in the statement of profit or loss, that being your income and expense items, between the pre- and post-acquisition periods. So if you're not familiar with the procedure, please refer back to lesson 1 before you start with this question. Okay, so the 31st of August is our date of acquisition. Okay, so therefore our pre-acquisition period, pre-acquisition period will be from the 1st of April 2019, which is the start of our current financial year, up until the 31st of August 2019. And your post-acquisition period will be from the 1st of September, just put an equal sign there, from the 1st of September 2019, and it will go up until the 31st of March 2020. So the pre-acquisition period consists of 5 months. Okay, April, May, June, July, and August. Okay, and your post-acquisition period will consist of 7 months. Okay, so you need to indicate this as, or in your calculation. So the total for the year, that will be 12 months. Pre-acquisition period in this question will be 5 months, and your post-acquisition period will be 7 months. Okay. Please make sure that you have determined this correctly, because if you did not indicate this correctly, your amounts will be wrong. Okay. So it's vital that you get this correct. Okay. Let's move on. So we have the date of acquisition, which is the 31st of August 2019. So just for the sake of completeness, we will also indicate it here at the Add Acquisition section, or in the Add Acquisition section. Right. Then, on the date of acquisition, or at that date, the equity of Netix Limited comprised of the following balances. So these were the balances at acquisition for Netix Limited. So we have share capital, more specifically ordinary share capital, amounting to 1.35 million. So ordinary share capital 1350. Okay. Then we have, and this balance should also be reflected in your trial balance. Let me just go back. Just hold on. So if you go back to your trial balance, you will see that the share capital balance for Netix Limited is also 1.35 million, because in this module, we will assume that the share capital of the subsidiary does not change since acquisition. So the balance that they give you as the year-end balance will be the same as the balance at acquisition, okay, which will be eliminated for consolidation purposes. All right. Then we have our cumulative preference share capital, your 12% cumulative preference shares, valuing 220,000. So we will indicate this right here in our analysis of owner's equity or preference share capital. Okay, we know that it is 12% cumulative preference shares. Once again, we assume that the share capital remained unchanged since acquisition. Okay, so we cross that out as well. Retained earnings, we do not yet know. Why? Because remember that we are required to just give the screen a minute or two. Remember, since the group itself was formed in the current financial year, okay, we need to calculate the retained earnings balance at acquisition by taking the pre-acquisition profit into account, as well as, in this question, there will be preference dividends for the pre-acquisition period that we also need to consider in calculating the retained earnings balance at the date of acquisition, which is why they have inserted a question mark right there. It's because you are required to calculate that balance using the pre-acquisition profit, the opening balance, which will be given in your trial balance right here. Okay, so that is the opening balance for retained earnings, and you will also make use of the preference dividends for that period. All right, so in our calculation right here, we will need to calculate the balance for retained earnings. So we will start with the balance on the 1st of April 2019, okay, which was given. So the balance given for Netix Limited as the opening balance for retained earnings will be 2,237,370. Okay, so 2,237,370 rand. Okay, 2,237,370. Okay, please make sure that you enter this amount correctly. Alright, so that was the opening balance for retained earnings on the 1st of April. Then we need to calculate the pre-acquisition profit, or the profit for the period 1 April 2019 to the 31st of August 2019, also known as the pre-acquisition period, and we will calculate this in calculation 3, where we have calculated the post and pre-acquisition profits. So we will calculate this right here, and then we need to subtract the preference dividends for the pre-acquisition period, which we'll do now. Okay. Let's look at the information, and then we have a balance for revaluation surplus amounting to 1,895,800. Okay, 1,895,800. Okay, that is the balance of revaluation surplus at acquisition. Now, Netix Limited classified the cumulative preference share capital as equity, as is the case in this module. Okay, we will classify preference shares as equity in this module. All right. Please refer back to study unit or learning unit 9. Learning unit 9. Right, for more information on that. Netix Limited did not have any dividends outstanding at acquisition. Okay, this is normally the case, so we do not worry about that. The preference dividends for 5 months before acquisition. Okay, remember the pre-acquisition period is 5 months long. So the preference dividends for that period were declared and paid on the 31st of August 2019. So it was paid on the date of acquisition. Okay, so we need to remove this from the retained earnings balance at acquisition. So your preference dividends for the pre-acquisition period would be calculated by taking the value of preference share capital, which is 220,000. We will multiply that by 12%, okay, because 12% is the dividend rate, and then we will multiply it by 5/12, because the preference dividends are paid for 5 months, and you should arrive at an answer of 11,000 Rand. Okay, so what we are doing here is that we are subtracting the preference dividends for the pre-acquisition period, okay, from retained earnings, and then we will transfer this amount to the analysis of owner's equity of preference share capital. Okay, let me show you. Let me just insert another few rows here. Let me cut this and put it there. Alright, so in your at acquisition section, because remember this occurs at acquisition, we have the profit attributable to preference shareholders. And remember, this is for the pre-acquisition period only. And this amount will be the same as the preference dividends that you have calculated in this section right here. So it will be 11,000. Okay, that is the value of the preference dividends that were paid to your preference shareholders for that period. So this is the amount that we owed, okay, for the pre-acquisition period, 11,000, and then we paid those preference dividends. Let me just correct this. Preference dividend paid. So then we paid the 11,000. Okay, let me also just insert our formulas. So we will format it as accounting, right? No currency, because we have shown it to be in Rand value. And we want negative amount in brackets. Okay, there we go. We just also increase the size. Alright. The amount attributable to the parent would be 80% of the total, okay, which is 8,800. And for the subsidiary, it would be 20% of the total amount. Okay, we'll calculate goodwill later on. Okay, let's enter our total consideration. Now that will be given in your trial balance as part of the investment in Netix Limited. So for preference share capital, it was 315,000. So you will enter that right here, because remember that goodwill is only paid by the parent. The NCI does not have a share in goodwill. Okay, it's fully attributable to the parent. And then for ordinary share capital, we had an investment of 8,560,000. Okay, that is the total consideration received by the parent. Alright, so we have calculated the preference dividends for the pre-acquisition period, and we have transferred it to the analysis of owner's equity of preference share capital. We subtracted it again because it showed that it was paid. Okay, so we do not need to pay this in the current period. Okay, that's been paid at acquisition. Okay, let's move on to point 2. Okay, remember we still need to calculate the retained earnings balance using all the information that follows. Okay, we will just cross out this one because we're done with it. We have calculated the percentage interest. This one can be eliminated because only the subsidiary has issued preference shares. Okay, remember we are doing the entire set of financial statements, so our calculations will be very detailed. Okay, so keep that in mind as well. Okay, let's move to additional information 2, which says the following. At the date of acquisition, so on the 31st of August 2019, all assets and liabilities of Netix Limited were measured at fair value except for land on which fiber transmission equipment was recently erected. This land had a carrying value of $440,000 and was revalued to $675,000. This revaluation was not accounted for in the revaluation surplus amount at acquisition, meaning that revaluation that occurred is not included in this balance right here. Okay, so we still need to add that balance because it was also on the date of acquisition, so it should form part of the balance of revaluation surplus at acquisition because it occurred on the same date. Now, at year end, in line with the group's 2-year revaluation policy, the land in Netix Limited was revalued again. Runet Limited did not have any revaluations in the current year. Okay, so we first need to determine the actual balance of revaluation surplus for the subsidiary at acquisition. So if you go to your analysis of owner's equity, you have to start with the given balance of 1895, and then we have to work out the additional revaluation surplus that should have been recorded or should have been included in this amount, meaning the difference between the 675 and the 440. Okay, we still need to account for this. So the revaluation surplus that occurred here would amount to 235,000. Okay. If you calculate the difference between 675 and 440, you should arrive at an amount of 235,000. So therefore we need to add the 235 to the revaluation surplus amount at acquisition, which will give you a total balance of 2,130,800. Okay, so this is the correct balance of revaluation surplus at acquisition. And if you read your information carefully, it just says that the company did not account for this revaluation amount at acquisition, meaning that we only have to adjust the given balance of 1,895,800 by the amount of 235,000. So here you actually just calculate the correct balance for revaluation surplus at the date of acquisition. Okay, now how do we calculate the current year's revaluation surplus? Okay, now if you look at your trial balance, you will see that Netix Limited has total revaluation surplus of 2,487,800 Rand. So if you calculate the difference between this amount at year end and the actual balance at acquisition, that will give you the current year's revaluation surplus. Okay. What they are telling you here is that the 235,000 that you have calculated, it is part of the year-end balance. Okay, so it is included in the balance on the 31st of March 2020. It is just not part of this balance right here. So the only thing you need to do is that you need to adjust this amount by 235,000 in order to calculate the correct balance of RVS at acquisition. Okay, So to calculate the current year's revaluation surplus, and just before I get to that, we only have a since acquisition to the end of the current year section. Why? Because remember that the group was only formed in the current year. So we cannot have a since acquisition to the beginning of the current year section. That will not make sense. Because the group did not exist as at the beginning of the year. Right. So just keep that in mind. So the current year's revaluation surplus for the subsidiary, so meaning for Netix Limited, we will take the year-end balance of 2,487,800, I believe. 2,487,800. And we will subtract the actual balance of revaluation surplus at acquisition, which was 2,130,800. And you should arrive at an amount of 357,000. Okay, so that was the current year's revaluation surplus. You will calculate the portion attributable to the parent as well as the portion attributable to the non-controlling interests. Okay, remember that these two amounts will be used in the consolidated statement of changes in equity as well as the bottom section in your consolidated statement of profit or loss. So if we go to our consolidated statement of profit or loss, I'm talking about, let me just open this. So I'm talking about this section right here. Okay. So the amount of revaluation surplus attributable to non-controlling interests would be part of the calculation for this amount. Okay, so just keep that in mind, which is why I say that it is vital for you to actually draw up or draft the analysis of owner's equity, because that one will help you a lot. Okay. Right, so let's move on. So we have calculated the correct balance for revaluation surplus at acquisition, and we have calculated the current year's revaluation surplus amount. Okay. And the parent did not have any revaluations for the current year. Okay, that's fine. There's no adjustments necessary there. Now, it is group policy to show goodwill at cost less impairment, and goodwill was not impaired during the current financial year. As I've said previously in point 1, the issued share capital of both companies remained unchanged since incorporation. Assume that each ordinary share carries one vote and voting rights alone are used solely in determining control. Meaning that we know that Renet Limited has control over Netix Limited because they possess a majority of the ordinary shares of the company. Remember that voting rights are normally only attached to ordinary shares, not preference shares. Now, before we get started with point 3, and we'll calculate goodwill a bit later on, alright, because we still need to calculate the retained earnings balance at acquisition, okay, and we can only do that after we have calculated the pre- and post-acquisition profits. Alright, because the balance of retained earnings at acquisition will influence the amount of goodwill paid by the parent. Okay, so just keep in mind that we will deal with it later on. Okay, so before we get started with point 3, let's enter our income and expense items for the subsidiary, because we will need to calculate the post and pre-acquisition profits as per the given information. Okay, I'll be right back. I just remembered something that I had to do, so stay tuned. I'll be right back. Hey guys, welcome back. Sorry it took a while. A bit of change of scenery as you can see in the background. Sorry about that. Okay, so we have finished point 2 under additional information. So we have calculated the correct balance for revaluation surplus on the date of acquisition, and then we calculated the current year's revaluation surplus for the subsidiary. It will be shown under since acquisition to the beginning of the current year or to the end of the current year section. As I've said previously, remember that we do not have a since acquisition to the beginning of the current year section because of the fact that the group was formed during the year. So there could not be a since acquisition to the beginning of the current year section. Okay, that would not make sense. And then I indicated that we are still busy calculating goodwill for ordinary share capital, as we are still required to calculate the retained earnings balance on the date of acquisition. Okay, so let's move on to point 3. And before we get started with point 3, let me just enter the income and expense items for the subsidiary in our calculations, because we will need to use those figures in order to calculate the profit for the pre-acquisition period as well as the profit for the post-acquisition period. Alright, so we start with revenue for the subsidiary, so that would be 13,743,000. So 13,743,000. Then we have other income of 9,640,900. 9,640,900. As I've also indicated, it is important for you to put these figures down exactly as they appear. Do not lose marks unnecessarily. Okay, so 9,640,900. Then we have our expenses. So the first expense that we come across will be cost of sales. So that will be 99,22,930. Okay. $930. Okay, so 99,22,930. Okay, as given. Then we have other expenses, or simply put your administrative expenses of 2,876,310, which we'll need to show as a negative amount. So 2,876. Let me just go back. 310. Yes, 2,876,310. And then our income tax expense for the year amounted to 2,020,020. Okay, giving you a profit for the year of 8,564,640. Okay, now as I've indicated in my previous lesson regarding the acquisition of an interest in a subsidiary during the current year, we will only include the amounts for the post-acquisition period in the consolidated statement of profit or loss, because only then can it form part of the group's income and expense items. And the pre-acquisition amounts will be used to calculate the pre-acquisition profit, which we will use again to calculate the balance of retained earnings on the date of acquisition. Okay, so this calculation right here would be calculation 3. Alright. So let's get started with point 3. And remember, once you've entered an amount in your calculations, you can just cross it out. Okay, that will help you focus on the remaining amounts. Okay, so if we look at point 3, it says that Netix Limited has been selling fiber cables to customers who entered into a fixed contract with the entity. The sales department was responsible for sourcing customers. Following the acquisition, Netix Limited paid the staff members in that division a bonus of, or to the amount of 700,000 Rand on the 25th of October 2019. Okay, what is the importance of this transaction? As you can see, the 25th of October 2019 falls in the post-acquisition period. Okay, it falls between the 1st of September and the 31st of March. Okay, so therefore the expense paid or the bonus paid by the subsidiary must be included in full in the post-acquisition period. So we cannot split this amount between the pre and post-acquisition periods, because it was only incurred in the post-acquisition period. And you would need to make the conclusion that the 700,000 is part of other expenses, alright? Because staff costs are not shown separately, so therefore we assume that it is included in other expenses. So what we will do is we will need to show for other expenses the 700,000, which is the bonus paid to the sales department employees, must be included in the post-acquisition period because it was only incurred in that period. It cannot be split evenly between these two periods. Okay, so 700,000 must be included in the post-acquisition period. So just keep that in mind. This is not an intra-group bonus. Okay, it was not paid to Runate Limited. Therefore, there is no elimination that needs to occur. Okay, keep that in mind. It is just for the purpose of including it in the post-acquisition period, as it only relates to that period. Then number 4 says the following. On the 15th of October 2019, so also in the post-acquisition period, the group resolved that Netix Limited would begin selling fiber internet to small businesses. The supply of fiber internet will require special fiber optic strands and cables called multi-mode, okay, and will require new fiber cables infrastructure. Now, the purchase of these multi-mode strands and cables will be supplied wholly by Runate Limited to Netix Limited. So what this means is that the subsidiary, Netix Limited, purchases all of the multi-mode strands and cables from Runate Limited. Okay, so you need to keep that in mind when calculating the unrealized profit, which we will do now. Now, inventory of the multi-mode fiber cables. So you would have made the conclusion that the multi-mode fiber cables are sold intra-group and therefore will include unrealized profit. Okay, but let's read our information very carefully. The inventory of the multi-mode fiber cables is sold at a consistent markup of 25% on cost. Okay, so that is the percentage profit made on the cost. Okay, you may assume that cost of sales in Netix Limited, so in other words the subsidiary, amounted to 3,592,888 Rand up to the acquisition date. So in other words, this is the amount for cost of sales for the pre-acquisition period. So we do not need to calculate it. They have given us the amount for the pre-acquisition period, and that will be 3,592,888. Okay, and your remaining amount, so the amount for the post-acquisition period will just be the remaining amount. So the total minus the pre-acquisition total will give you the post-acquisition amount, okay, of 6,330,042 Rand. Okay. So this is for pre-acquisition and subsequent to acquisition. So in the post-acquisition period, cost of sales in Netix Limited amounted to 6,330,042, which we have calculated here. Right, so that is just for confirmation. And once again, if you add these two amounts together, they will give you the total cost of sales for the year. Alright, so just make sure of that. And this amount, so the amount of cost of sales in the post-acquisition period included intergroup sales of multi-mode fiber cables from Runate Limited to Netix Limited of 1.3 million Rand. Okay, so clearly we have intragroup sales because it occurred in the post-acquisition period, and we know that the group existed in the post-acquisition period only. So we need to eliminate this amount of 1.3 million as intragroup sales. We know that Runate Limited made the sales to Netix Limited. So our journal entry will be, let me just show you. So our journal entry will be that our journal entry, in order to eliminate the intragroup sales, will be to debit the sales account of Runate Limited by 1.3 million, and we need to credit cost of sales for Netix Limited. Okay, this will be the elimination of intergroup sales. So in your consolidated statement of profit or loss and other comprehensive income, your revenue amount, so we will start with the amount for the parent. As I've said in lesson 1, we include 100% of the income and expense items for the parent, because the parent is the one controlling the subsidiary. Okay, so all of the parent items must form part of the group. So if we look at revenue for the parent, it is 29, let me just put this in brackets, 29,731 830. Okay, we are still calculating the amount for revenue for the post-acquisition period, which we will add to this amount. Okay, but we can eliminate the intergroup sales at this stage. So because the sales account of Renet Limited is debited, we decrease revenue by 1.3. Okay, which is why it is subtracted. And then for cost of sales, you will start with the amount for the parent, which in this case is given as 17,903,640. Okay, 17,903,640. And then because we credit cost of sales for Netix Limited, we are decreasing cost of sales for the group. And we have determined the amount for cost of sales for the post-acquisition period, which will be the 6,330,042. Okay, that is the cost of sales amount for the subsidiary for the post-acquisition period, which we will add to the group's cost of sales. Calculation 3. Keep in mind that this amount of 6,330,042 Rand includes the intergroup sales which we have eliminated. So it would be incorrect to eliminate it again. Okay, so you just add the amount for the post-acquisition period. You have already removed the intergroup sales, so do not eliminate it again. Okay, so we have dealt with the intergroup sales. Okay, we have eliminated that, but now we need to determine the unrealized profit. Now they give you they state that 25% of the closing inventory of Netix Limited at year-end consists of the multi-mode fiber cables. So if you go back to your trial balance, okay, before additional information, so the inventory for Netix Limited amounts to 7,309,300 Rand. Okay, so according to the information, only 25% of this amount right here consists of the multi-mode fiber cables. Okay, meaning that only 25% of the closing inventory will include the unrealized profit. Okay, remember that all the multi-mode strands and cables are purchased intergroup. Okay, so first we need to calculate the value of the multi-mode inventory. So the value of multi-mode inventory, because this is the only type of inventory that is purchased intergroup, so therefore includes unrealized profit. Okay, because it was sold intergroup, will be the value of inventory, which is 7,309,900, I believe. Let me just make sure. 300. Okay, 7,309,300. And then we multiply that by 25%. And this will give us the value of the multi-mode inventory, which is 1,827,325. Okay, 1,827,325. So this is the value of the inventory for Netix Limited that includes the unrealized profit. So therefore, the unrealized profit will be equal to 1,827,325, and then we multiply that by 25 over 125, because according to the information in point 4 rather, the multi-mode fiber cables are sold at a consistent markup of 25% on cost. Okay, so we use the 25 in order to calculate the profit, and we use 125 because this amount right here already includes the unrealized profit of 25%. Okay, and your unrealized profit that you should eliminate for consolidation purposes will amount to 365,465. Okay, that is the unrealized profit that we need to eliminate. Okay, so your journal entry will be that we will debit cost of sales of the company who made the profit. In this case, it was Runet Limited. And we will credit inventory for Netix Limited. Right, so in your consolidated statement of financial, in profit or loss rather, so in your consolidated statement of profit or loss and other comprehensive income, you will need to increase cost of sales because it is debited by the amount of the unrealized profit included in closing inventory, 365,465. Okay, and then in your consolidated statement of financial position, remember for the purposes of this lesson, we are drafting all the group's financial statements. Okay, so in your consolidated statement of financial position, total value of inventory for the group will be that of the parent, which is 8,985,760, or not, 8,985,760. Okay, plus that of the subsidiary, 7,309,300. So 8,985,760. Let me just make sure. Okay, and then that of the subsidiary, 7,309,300. And then we remove the unrealized profit of 365,465. Okay, that is the unrealized profit included in closing inventory. So for this piece of information, you first had to calculate the value of the multi-mode inventory by calculating 25% of the closing inventory. Okay, that is as per the information given. And based on this value, you calculated the unrealized profit that you will eliminate for consideration purposes. Okay, why does this amount include unrealized profit? Because it was purchased intergroup in the post-acquisition period. Okay, we'll keep that in mind. The agreement was reached or concluded on the 15th of October 2019. So since that date, the intergroup sales started, or has taken place. Rather. Okay, and then you can calculate your value for inventory for the group. 760 plus 7,309,300, and then you subtract 365,465 because inventory was credited, and then you should get an amount of 15,929,595. Okay, 15,929,595. Okay, that is the value of inventory for the group. Okay, we will also be able to calculate our value for cost of sales for the group. Okay, because there will be nothing else affecting cost of sales for the group, because we have dealt with the intergroup sales and we have dealt with the unrealized profit included in closing inventory. So your cost of sales for the group for the year ended 31 March 2020 would be 23,299,147. Okay, 23,299,147. Alright, we still need to calculate the revenue for the post-acquisition period. Alright. Okay, so we have dealt with intergroup sales, we have eliminated that. We have a portion cost of sales between the pre and post-acquisition periods. We have eliminated intergroup sales, and we have eliminated the unrealized profit included in closing inventory. A question that you might be asking is, why do we not adjust the analysis of owner's equity? Okay, So in other words, why do we not show the unrealized profit here? Remember, the profit was made by the parent, not the subsidiary. If the subsidiary made the profit, then you would show the adjustment in your analysis of owner's equity. But because in terms of the inventory, the parent made the profit on the intergroup sales of inventory, there is no adjustment in the analysis of owner's equity. Only in your consolidated statement of profit or loss and other comprehensive income, as well as your consolidated statement of financial position, because we have eliminated the unrealized profit from inventory as we have shown here. Okay, so please make note of that, or take note of that. Okay, let's get to point 5, which says that Netix Limited leased machinery designed for the installation of the fiber cables from Renet Limited. Now, the lease commenced on the 1st of January 2020, so post-acquisition period, and amounts to 250,000 Rand per month. A new lease will be entered into each year, as it is not reasonably certain whether the lease will be extended for more than 12 months. Netix Limited has elected to expense the lease payments on a straight line basis over the lease term, and Renet Limited treats this as an operating lease. Okay, all that this piece of information means is that the amounts paid / received for the lease itself will be included in other income and other expenses, more specifically administrative expenses. Okay, that's the only thing that you need to note regarding this piece of information. Okay, so if we calculate the total lease payments for the year, it will only be for 3 months, okay, because it will only be for January, February, and March 2020. Okay, so the total lease payments, operating lease. So the total lease payments will be 250,000 because that is the amount per month, and we will multiply it by 3 as I've just indicated, and that will give you an amount of 750. Okay, now keep in mind the 750 was received by Renet Limited. Okay, so therefore this amount will be included in his other income, and since it was received intra-group, we need to eliminate this amount for consolidation purposes. So in your consolidated statement of profit or loss and other comprehensive income, you will start with other income for the parent. So the parent's other income currently amounts to, let me just do this very slowly. So other income is 11,888,000. Okay, so 11,088,000. Okay, 11,088,000, and then we eliminate the intra-group lease payments received because it will be included in the parent's other income, and you will subtract it from other expenses. So the subsidiary's other expenses, meaning this amount right here, okay, the 2,876,310 will also include the lease payments, so therefore we have to eliminate that as well. So for administrative expenses, you will start with the parent's amount, which is 4,884,120. Okay, so 4,884,120, and then we eliminate the intra-group lease payments made. Okay, keep in mind we are still calculating the administrative expenses for the subsidiary for the post-acquisition period, which we will add to this amount, okay, or to the group's administrative expenses. We just eliminated the lease payments so long, so we don't have to worry about that at a later stage. Okay, now that it has been eliminated, we need to now apportion, or we need to determine the effect on the calculation of the post and pre-acquisition profits. So if we go to our calculation right here, now the lease agreement itself was concluded on the 1st of January 2020. Okay, the 1st of January falls in the post-acquisition period. So therefore, all the lease payments, okay, amounting to 750,000 must be included in the post-acquisition period. Okay, and we cannot split that amount between the pre and post acquisition periods. So in your calculation, you need to make a note that you will include 750,000, because remember this was paid by the subsidiary, so it will be included in other expenses. So the 750,000 is in respect of lease payments that only pertain to the post-acquisition period. Okay, so it can therefore not be split between the two periods. Alright, so you must include it in the post-acquisition period. Okay, so we have eliminated the intergroup lease payments / receipts, and we have included it in full in the post-acquisition period because it only pertains to that period. So we are done with point 5. Good. Let's get to point 6 now, which says the following. Advanced fiber transmission equipment was sold by Netix Limited to Runet Limited. Okay. The equipment had a carrying value of 1,035,000 Rand on the 1st of April 2019. So this was the carrying value at the beginning of the year. Okay, keep that in mind. And was sold for 1,053,000 Rand on the 30th of November 2019. The group provides for depreciation on a straight line basis at 10% per annum. Now, before we start, let me just address something. You need to read your dates carefully. We cannot calculate the profit by just subtracting these two amounts from one another, because the date of sale is the 30th of November 2019, and this was the carrying value on the 1st of April 2019. So we first need to write off additional depreciation in order to calculate the real carrying value on the date of sale. Only then are we able to actually calculate the profit made. Now, this one also bothered me at the beginning because they say that we calculate depreciation on a straight line basis, but we do not have the cost of the equipment. Okay, there is not enough information for us to calculate the equipment's cost. Right? So therefore, the method actually applied is the reducing balance method. Okay, where depreciation is calculated on its carrying value. Okay, so for the purposes of calculating the additional depreciation written off on this equipment, we will use the reducing balance method. So we will just take the carrying value of the equipment in order to calculate that amount for depreciation. Okay, let's do that. So first we calculate the additional depreciation written off. So equipment sold intergroup, because it was sold by the subsidiary to the parent. So additional depreciation written off, and this will appear in Netix Limited records, remember, because they sold the equipment, so they would have written off additional depreciation. Okay, as I've said, we will assume the reducing balance method because we do not have enough information to calculate the cost of the equipment. All right. So we start with the carrying value at the beginning of the year, 1,035,000. Okay, we will multiply that by the depreciation rate, which is 10% per annum, and then we calculate or determine the number of months for which depreciation must be written off. And if you calculate the number of months from the 1st of April 2019 up until the 30th of November, it will give you a total of 8 months. So the additional depreciation written off should amount to 69,000 Rand in total. Okay, now before we go further, okay, remember we still need to split this between the pre and post acquisition periods. Okay, or we need to determine whether it must be split between the pre and post acquisition periods. Okay, now this amount covers the period 1 April 2019, which is in the pre-acquisition period, and it goes up until the 30th of November 2019, which is in the post-acquisition period. So therefore, there is one portion of that 69,000 that pertains to the pre-acquisition period, and the other portion pertains to the post-acquisition period. Okay, so how do we actually calculate the portions themselves? Okay, so the amount for this, for the the pre-acquisition period, okay, will be that we take the amount of 69,000. Now, as we have stated at the beginning of the lesson, the pre-acquisition period consists of a total of 5 months. Okay, so we want the amount for 5 months. Okay, and we have written off depreciation on this equipment for 8 months. Okay, so we have 8 months. So therefore, we multiply by 5 over 8, and you should get an amount of 43,125. Okay, so of this amount of 69,000 Rand, which is additional depreciation written off by Netix Limited on this equipment, 43,125 pertains to the pre-acquisition period, okay, and must be included as such. Depreciation is included in other expenses, so 43,125 pertains to the pre-acquisition period, and the remaining amount would logically apply to the post-acquisition period. Okay, which will just be the difference between the 69 and the 43,125, or you could take the 69,000 and multiply it by 3 over 8. That will give you the same answer, and you should get 25,875. So this is the portion that applies to the post-acquisition period. So we need to include it in the post-acquisition period, along with the lease payments as well as the bonus paid to those staff members in the sales department. Okay, so 29,875 forms part of the post-acquisition period. Okay, guys, you're gonna have to excuse me. This will be part 1 of question 2 for May-June 2022 exam. In the next video, we will continue with our calculations, and we will start with, or we'll finish point 6. Okay, we will finish point 6 in our next video. So do not panic. I really need to I have other things to attend to right now. So in the next video, I will finish with point 6, and then we will finish the question in full. I'll see you next time.